Well, hello everyone. This is trigg.minnick with Keller Williams out of beautiful Orlando, Florida, Waterford Lakes area specifically. Anyway, we are here today to discuss how we analyze rental properties from a cash flow summary and a complete investment analysis. And by that, I mean we're going to go beyond the, oh, we need 1% of our purchase price in our monthly rent. We're going to go well beyond that. We're going to look at our effects of tax savings through depreciation and interest and how we can calculate that and show you why, even though a property may not cash flow well, it could still be a great long-term investment. So in the spreadsheet here, all of our columns in gray are our inputs, and we want to make sure that we include all of our initial costs and all of our ongoing costs as well. So we break down the different categories for our expenses. We can dive into deeper detail on some of these things when we have more time, but also on our income, we want to make sure that we're including some chances of vacancy. And here we said 5%. So let's get down to this. So wherever we see the black with the white lettering, that's where we have our real data output that we want to see. So in this case, we have a an operating income of about $16,000 on a $300,000 purchase and a gross rent of $27,000. So our capitalization rate, i.e., how much are we making annually off of our purchase price, is about 5% for this one. So we can also readily see our monthly net cash flow, operating income there. Now, when we get to evaluating this for a full investment, wealth building analysis standpoint, we've got to understand a couple of other things. We have to have the input of what the tax rate is, and we want to make sure that this matches the bracket that we're actually affecting, and we can talk more about that offline, but we also want to separate out the value of the improvements versus the land value, because there's differences in how we can appreciate those, i.e. we can't depreciate land. And then we get to input an annual appreciation amount, because that will affect our wealth over time. So we'll just key in something there for now, 5%. This market's low, but overall long term it's probably a little high. Now, when we go to financing, we're going to break that down to what our down payment is. Typically, in investor lenders going to be looking 20-25% down. So that's what we put in here, and they'll tell us our cash out of pocket, our monthly payment, and from that, we're also going to look at our annualized debt service. We're going to add in our expenses to get to our debt service coverage and our debt service coverage rate, and that is a big factor in what lenders will look at when they are lending for investment properties in many cases. So you see here our net cash flow is really low, almost non-existent, when we're financing the same property that was giving a $16,000 in net operating income. But that doesn't mean it's a bad investment. So what we need to understand is the effects on our taxes, the effects on our wealth building as well. So we're going to break that down into looking at the amount of interest we paid, because that becomes tax deductible. IRS says we can depreciate the asset over 27.5 years, and we can also write off our operating expenses. So when we add all these up, we take our tax rate to that, and then we get our tax savings in real dollars here. Add in our cash flow after tax. Now, as this home is being paid down, we're building equity because we're lowering the amount we owe. And in this case, in the first year, we lowered that amount by $2,763. Add into that our estimated annual appreciation. Let's change that to 4%. And we have a total return on investment, $23,000 for the year for a property that didn't cash flow. So even though we're not cash flowing, done properly and considering all the factors, an investment like this into a rental property can be a great way to build your long-term wealth. If you want more questions on how to analyze this or on investing, feel free to give me a shout. This is Trigg. I'm out.